Hi, I'm Jimmy. In this video, we're going to look at the US economy. So we're going to go through various economic indicators to see, are they giving us bullish signs or bearish signs? And ultimately, we're going to try to rate where things are at today to try to help us answer the question, should we invest now or wait for the stock market to pull back? With that being said, let's jump into our first economic indicator. So up first, we've got inflation. Inflation measures the change in price from period over period, in this case, year over year. So we can see that, well, with the most recent number, inflation was sitting at about 3.3%. By the way, the Federal Reserve says that they target somewhere about 2.5. So let's say between 2 and 3%. So 3.3% is actually somewhat on the high level. I drew this line here because I wanted to point out that this chart, which goes all the way back to the 1990s, well, the current inflation level, although it's way back off of the highs, is still quite high. But what if we were to compare that to wages? Because inflation and wages are often tied together. Well, this economic indicator is a measure done by the Federal Reserve to determine the average wage growth amount, again, from a year-over-year basis. So the green line here is showing that, yes, wage growth is also down a bit, but right now it's sitting at 5.2%. Compare that to the 3.3% inflation rate, that's kind of a good thing. So when we jump over to our economic scorecard here, well, clearly to inflation, we got to give that point to the bears because inflation, I think, is still in the higher range. So that's got to be a point for the bears. I was considering going a neutral point and putting a point to the bulls and the bears, but I just don't think that makes sense. It's still a bit too high right now. So the Fed has to do what they can to try to lower that a bit. Well, when we look at wages, on the other hand, well, wages are a good thing. They're still sitting up above 5%, which is fairly strong considering the historical numbers. So right now we got 1 point apiece. Okay, now similar to the wages discussion, now we have unemployment. So this is the unemployment rate, again, going back about the past 20 years. And right now the level is, although it has been going up recently, it's still relatively low. I mean, look at how low this is compared to any time over the past 20 years. Only a couple times has it been this low. So clearly, I think that unemployment, much like wages, has to be a point for the bulls. So right now we got 2 points for the bulls, 1 point for the bears. Okay, now let's jump over and look at debt. Now, I'm not talking about debt for the US government, but instead household debt. So this debt represents the percentage of household debt relative to GDP. Right now, it sits at about 71%. Now, this is clearly high when we look at this chart, which is the past 50 years. So that's kind of high. But considering that we haven't been this low in the past 20 or so years, and let's call a spade, in the past 20 or so years, the economy, the stock market has done fairly well outside of some notable pullbacks in there. In fact, we haven't been at this level since about 2001. So I would think that this is a positive sign. Now, there's other ways to measure household debt other than measuring it relative to GDP. So one other way to measure it is to look at credit card debt. And this chart tracks, going back to, again, the past 20 years, what percentage of accounts, credit cards account, are 90 days or more late on their credit card payments. And in the past couple months, we've had a relatively big spike, bringing up the numbers to the highest level we've seen since the financial crisis. So clearly, where the other chart looked pretty good for total household debt, rising credit card debt or rising lateness on credit card payments can be a real problem. So this is one of those that if we're going to group debt together on the scorecard, I think it makes sense to give one to the bulls and one to the bears. Now, if I were leaning in a direction, I'd probably go more bearish here because this is more of a negative sign. But I think in the name of fairness, one on each side seems logical at this point. Okay, now let's jump over to another one that I think is one of the most important economic indicators that we look at, and that is consumer confidence. So right now, consumer confidence has actually dropped a decent amount since we last did this video. Last time we did this video, I believe I had consumer confidence as either a bullish point or perhaps a neutral point. I forget where it was, but when we look at this chart going back the past 20 years, it's kind of low. It's certainly on the low end of consumer confidence, and that is by no means a good thing. Having the consumer nervous about their economic standing, that's how they measure consumer confidence. Having the consumer concerned is a bad sign, especially when we look at the times that it dropped below it. 2 out of the 3 times it dropped below it. One was the financial crisis, and the other was COVID. Clearly, those were unusual times, and we're getting down to that level now. So this, I think, is a bad sign for the U.S. economy. So when we jump over to our scorecard, I think it only makes sense to give this point to the bears. And I actually think that this one, if we're going to weight these, I think the bearish point for consumer confidence is one of the most important ones to consider. So right now, although it looks tied, I think I got to give the win right now to the bears. Okay, what about housing? So now we jump over and look at housing starts. So housing, this is the number of new houses being built. They file permits. How is the number done? And we can see that for a while it was trending higher, but then recently it kind of started trending lower. So that's going to be a weak sign for the broader economy. In fact, the more houses being built, you're causing new jobs. People are in theory buying those houses. It helps spur the economy. One healthy indicator for the economy is to have a strong housing market. Not so strong that housing prices start going through the roof, which is what this economic indicator looks at. So this is the price of existing homes, according to the National Association of Realtors. And we can see that house prices, especially post-COVID, they went a little bit nuts. It was a big jump, and then they kind of bumped up against this level, which kind of made sense. And I was okay with that. Here's my issue, though, is we recently broke out of that. And technically, fundamentally, rising housing prices is a good thing. It's supposed to be a textbook. What you'd learn in school is that rising housing prices, broadly speaking, again, this is a chart over 20 years, is a good thing because it's not just people buying houses, but the value of people already own houses are going up. They could take out home equity loans. They could sell their house for a bigger profit. On the flip side is it's more difficult to buy a house. Housing prices are getting out of reach for many Americans, and that could be a problem. And only because I don't have a better answer here, and I'm real curious what you think in the comments below, but I gave this one kind of a neutral point because I know textbook-wise, rising housing prices are supposed to be a bullish sign. And we saw the gradual decline in the number of housing starts, and that's a bearish point. Again, I'm probably leaning more bearish with this one. But in the name of giving, the textbooks their credit, rising housing prices, the fact that people that own houses, their house is worth more, could be considered a good sign. So I sheepishly go with the neutral, bearish, and bullish point here. Okay, that being said, let's go to something a bit more clear cut, and that is the ISM Manufacturing Economic Indicator. So this one's real simple. 50 is the most important level here. Anything above 50 implies growth in the manufacturing sector of the US economy. Anything below 50 implies negative growth. So right now, it's below 50, and that is negative growth, and that is clearly a bearish point. I like it when they're simple like that. By the way, I'd be curious how you guys would score this so far. If you're curious, if you disagree with any of the points that I've made throughout this video, please let me know in the comments below. I fully recognize that some of this stuff is fairly subjective. So if you have a different opinion, that's okay. Feel free to share that. I'm curious to hear what everybody thinks. Now, outside of consumer confidence, another economic indicator that is crucial is the US yield curve. So this is a bearish point. Spoiler alert, bearish point, because it's inverted. So basically, the way that this works is it measures time. So there's 3 months, 6 months, 2 years, 5 years, and 5, 10, and 30 years. Basically, what interest rate are you getting if you were to lend money to the US government? So if you were to buy a 3-month bond, right now, if you were to buy a 3-month bond from the government, be 3-month treasury, you would get a higher interest rate than you would if you get a 10-year bond. And that's backwards. It's supposed to be the other way. It's not supposed to be inverted like this. This is called an inverted yield curve, and an inverted yield curve has preceded every recession the US has ever had. Now, the joke that I've heard is that the inverted yield curve precedes 5 out of the past 4 recessions or some such thing. Basically, just because it's inverted doesn't mean that there will be a recession, but there hasn't been for like the past 100 years or something, there hasn't been a recession that was not first preceded by an inverted yield curve. Now, I would point out that the the inversion can be fast. For example, COVID. When COVID happened, interest rates got dropped quickly and the inversion of the yield curve inverted real quick. So, kind of a, I guess a unusual way to look at it. But in general, outside of COVID, outside of once every 100 year, you know, viruses that are hitting the planet, outside of those rare instances, this is a bad sign. And this has been this way since COVID. This has stayed inverted for a long time. And this is a bad sign for the economy. One of the primary reasons to recognize that this is a bad sign is banking. So, in order to have a healthy economy, you got to have a healthy banking industry. Banks borrow money at short term interest rates. So, let's say 3 month. In fact, they usually borrow like overnight rates, but still, they borrow on the short end and they lend out at the long end. If they borrow at 5% and they lend out at 4%, they're losing money. Because don't forget, if we were to deposit our money at a bank, we get short term interest rates. So our interest rate, they're paying us, and then they're giving us a mortgage at a lower interest rate. Now, I'm oversimplifying it. It's not that clean, and banks can still make money, but it's far easier for them to make money with a normal yield curve. So this is clearly going to be a point for the bears when we jump over and look at the scorecard. Now, what's interesting here is this is actually one of the first times that we've been doing this, that we've had 4 bearish points. I don't know if perhaps I'm just scoring it differently, but I was a little bit surprised when generally we're much more 50-50. And that's usually the way the economy is, that, it kind of teeters. It doesn't usually, skyrocket or tank. The stock market can, because the stock market's insane. But the US economy, generally speaking, doesn't work that quickly. So this is a bit of an unusual situation. And now, to answer the question, do we invest now or wait for the stock market to crash? The interesting part about the stock market today is that many of the world's largest companies, if you think about the Magnificent Seven that we're currently doing a series on where we're analyzing all the companies, well, those companies are pulling the stock market up. A lot of the other companies, in the smaller companies in the world, are in the US economy, at least the US stock market, are not doing nearly as well as those big companies are. So I think that there's still plenty of opportunities in many smaller companies. By smaller, I mean not the top 10% of the world's largest companies. I think there's plenty of opportunities out there. So I think if we're looking for value, I think that's the place to look for it. Now, to try to make value in companies easy, we actually built an investment platform called Investors Grow, where basically you punch in the ticker and it kicks back what the fair value should be using analyst estimates for free cash flow. Now, in addition to free cash flow, we also have things like price to earnings, price to book, different ways to value companies, where it gives us the history of that company and tells us whether or not perhaps the company could be undervalued. In addition to this platform, we also do free private investing live streams each week where we talk about investment portfolios, macroeconomic indicators, things along those lines. And then we talk about my portfolio. We do different analysis on different companies. We do researching, things like that. There's a whole bunch over there. If you're curious, I'll leave a link to that in the description below. Besides that, thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.